We have a recording happening now.
Yeah, so all of that is fine. Let's yeah. Don't, I think I'll try this, Richard. I just found something on site. We'll see about this. Okay.
Okay.
I have to let me see if I have to go through some other stuff here. Connect. And where is that? I'll try this here. Try this here first. And let's see how this works. I am. It's a pleasure to try to serve you, sir. Let me know. Can you see my screen?
Yes.
Can you see my screen?
Yes, I can see your screen.
Okay, so hopefully this is kind of it'll be leading. I'm going to add some context to it. All righty.
Okay.
All right. So did you have you remember we talked about FI, and then we talked about invoice verification, logistics invoice verification.
Yes.
You had intended to look at that or review that.
Yes, yes, and I've actually already been studying it. Except I was studying it through the guise of bank accounting, but it's the same menu paths to get to the same activities. But they just titled it as being under bank accounting, but really it's under logistics, which is
Somebody added on the bank accounting. Oh, okay.
They put in the bank accounting chapter, but the menu path is obviously through logistics, right?
Through logistics. Okay.
Mm-hmm.
So,
yeah, so I can even tell you off the top of my head it's the accounts. It starts with the payment proposal and payment run, then it goes to the automatic account, the automatic payment program, and then that leads to what
no, I was thinking about I was thinking about the logistics invoicing, not the payment program or banking. I didn't see how it related. The logistic invoice verification piece, what we talked about
Okay,
last time.
that's not the automatic payment program.
No, sir.
No. Oh.
It was logistic invoice verification. I was saying that 80% of accounts payable is probably over there.
Mm-hmm.
Is in logistics invoice, is processing invoices. Remember we were talking about Myro was the transaction.
Mm-hmm.
It was entering an invoice in reference to a purchase order. Does that ring a bell?
Yes, yes, absolutely.
Okay.
And please forgive me. I'll double back and look into it a bit more.
Yeah. So it was like, let me see if it's in here. Yeah, it was Yeah, I don't see it in there. But let's, if you see my screen, let's kind of,
Oh,
you with me?
yes.
Okay, so let's see what this accounts payable piece is, right? Which you probably have, right? Do it. So if we can kind of hit this section, if you see like account groups, right, in the configuration, you will see this in the configuration that it would be the account groups is giving you this this menu path in the IMG, and you'll get to define account groups. You probably had it already documented, right?
Mm-hmm. Yep.
And so just taking you down and find this is account groups and this is define account groups. But you're going to have an account group for all of the vendor masters. And you, I saw you had this defined previously. Does
Mm-hmm.
this ring a bell?
Yes, it does.
And basically, what it's just really doing is when you have you're just trying to logically organize your vendors into these different groups.
Mm-hmm.
Domestic, foreign, domestic, intercompany is three groups you can kind of define into a particular group of vendors, right? Um,
Mm-hmm.
so basically, when you define the group, defining like here is it like you say they had domestic, import, or could be intercompany, or could be international, or it could be intercompany, as some examples. But when you get to, there is this three sections here, so somewhat. A vendor has kind of three areas: a general area, a company code area, and a purchasing group, right? And now, and then when you get to the, and so what you're saying is that, okay, this is the account group. And when you get to the field status section of that, you are defining what, when you create a vendor master record, what fields would be required or optional. Anytime you see a field status grouping, right? Field status grouping, it's all about defining the fields that you need to populate when you create the master record. So you can see when you see a field status grouping, you go into one of them, it's going to have these buttons in it, right? That's all. And if you were to suppress this buttons here, then when you go create that vendor master, you will not see this field, right? If you suppressed it. If you made it a required field for for whatever reasons the reasons that you needed to make it a required field, then you cannot save that record until that field is populated, and so on and so forth. Okay. So now, as part of the grouping of a vendor, as part of a grouping, when you create a vendor account group, you define what fields are available when you create the master. Okay. That's kind of its, the other piece to it is when you do this same grouping, you give it a number range, right? So that you can organize in the, so when you come finish that grouping, you're going to come back and assign that group to a number range. So you're going to create a number range, like this is just creating a number range. And then when you get done with the number range, you're going to come back and assign that number range to the group. So you can say all domestic vendors starts with a 5, all international starts with a 4. So the main purpose. So what are the two main purposes of a vendor group? or three main purposes of the vendor group that you can cite. I would say you can organize the vendors into logical groups. It's an organizational tool. It allows you to define what fields and that are required when you create a vendor master, and you define the number ranges.
Tracking.
Now, vendor
group, the vendor group number range, number, and the actual number range, and linking the business partner to the vendor group. What was it? What was the third one?
The ability to organize them in logical groupings. You know what I mean?
Yes, I'm tracking.
Yes. You know, so now when you see, so just know that this information is transferable to customer masters, vendor masters, and GLs. They use the same concept. Field status groups defines what fields you will be required, what fields will be suppressed, what fields will be displayed, what fields will be optional when you create the master record. And of course, we know that the master record in the configuration data dictates the process. So if you want something like payment terms to be required, you don't want a vendor to be created unless you add the payment terms. So you make the payment terms required, right? As an example, so that you will never have a vendor master without payment terms. You just won't have it. You know what I mean? So you have to make it required, or it won't get populated, right? Or it'll be mixed population. Sometimes somebody put it in, sometimes they don't. So, but that same concept of the count groups, and you're defining the field status within the count groups and the number ranges and the organization of the vendor groups, is the same concept for customers, same concept for GLs. All right. And so now when you just so that you're, so if you have a general ledger, you would create an account group called cash, account group called AR, account group called fixed assets. And then you would make sure those fields, when you create one of those accounts within those account groups, it's going to have its own unique number range. Like all cash is going to start with a 1, and all AR is going to start with a 1 1, or, you know, and so on and so forth. All right. So you assign it to the group. Question, sir, before we're moving on.
Question. Well, I'm tracking.
Okay. Now, part of the things is that when you also create I'm just going to move on to tolerance groups. So when you create a tolerance group, you can do, it's the same thing. It's the same thing for customers and vendors and general ledgers. Basically, you're saying, so for this particular group, what you will allow, you know, for differences, what you will allow for change, what you're going to allow to be written off. You follow me? So if you had a payment and this vendor belongs to this particular group, and there is a difference of payment of 10%, and it's a 10% loss or a 10% gain, you will define it in here saying, okay, so you're going to put some restrictions on the particular vendor that you cannot write off because of the vendor belonging to this tolerance group. You cannot write off above 10% or 5% or whatever, right? And so you would assign it to that group. And what you're doing is just putting some controls into the system. Now, usually these accountants and controllers, when they do it, they define what that should be. You know what I mean? Is it a dollar amount or is it a percentage? All righty. Question about that. Any question?
No questions. Okay.
Okay. Okay. So now, when you do set up and you see it has a dollar amount and a percentage amount, right? A dollar amount and a percent. When you typically see these kinds of screens in terms of tolerances, the system will take the most conservative, uh, uh, most conservative approach when it needs to be used. Now, $100 is not necessarily 5% when you have $10,000 as a $10,000 value, right? So if you were to take 5% of $10,000, you will be looking at, what will you be looking at? $1,000 or something, or $500, right? 5% of $10,000 is $500. All right. Now, if it had to decide which one would be the most conservative, $100 or 5% of $10,000, it's going to take the most conservative approach. Generally, this is how this, when you see both these in an approach. So it will limit it to $100, right? When I say the most conservative, it will be the least. That's the most conservative. It's the least amount. So, and if it was a amount of $1,000, right? Whereas $100 represent 10% and 5% represent, $50. Okay. So if you're trying to write off a value, uh, $50, it would, you try to write off $100, it's going to restrict it because 5%, $50 is less than $100. Yeah. Yeah. All right. Questions about that? What's the most conservative and why it tries it? It will use the tolerance that's the most conservative view in these situations.
And the most
And you
conservative
say
being the least amount.
the least amount. Yeah.
Mm-hmm. I'm with you.
Yeah. So like in this case, enter the amount is $100 or 5%, whichever is lower. The system will will use the lowest. In conservatism just not in this conservative view is just meaning that you err on the side of the least impact. That's what that kind of means, right? Okay. Does that work, Rich?
Yes, I'm with you.
Okay. So now, so I'm just adding some color to this, right? What you were saying. Now here is the payment terms. You've seen the payment terms, but these payment terms is just simply, so now this is kind of this is the screen. It's all you do. The same screen is for customers and vendors, and you will check the mark when when the term is applicable to both. You would just check it out, right? This is generally the description of the text, and it typically modifies when it's kind of self-defining when you put these explanations down here, and it kind of create. But a typical term is that a vendor, you must pay the vendor uh, when you say 210 net 30, something like that. This is 5% in 14 days, 2% in 20 days, and 30 days net. What does that mean to you? 5% in 14 days, 2% in 20 days, and 30%.
You get a 5% discount if you pay it in 14 days, and a 2% discount if you pay it within 20 days. But if you pay it after 30 days, then you got to pay the whole thing.
You have to pay the whole thing. Yes. And this particular one is applicable for both customers and vendors. All righty. Now, if you take this field here, if you want that, and if you needed to add, notice that there's only 2 in here, right? But if you needed to have a second one, like let's say 14 to 20, and then from 25 to 30, and from 35 to 40, let's see if you needed to break this in, just break this up into 4 parts. You know what I mean? Next month, and then you add, let's say you keep adding if it's paid within 45 days or 50 days, but you don't have enough ranges here, right? So you can have on this, you would put this right in here, and you can limit the days, and you can have this same CPO1. You see the CPO1 is the name of the term. And if you put 15 days, and then that will chop up that one term, and you can create 2 terms out of 1 term if you give it a day limit. You follow what I'm saying? Let's see if you can. So for example, I can create 1 term, and I can split the term up into two phases of a month, right? If I say the date that for this particular term in 1 month, the day limit is the 15th. And then I would have CPO 1, and then I have the 30th right here. But the same using, whenever I use CPO 1, I'm going to have two master files on it. It's going to be one for the 15th and one for the 30th. I just wanted to point that out, because it really, you'll see people don't necessarily explain it. All righty, because no one really knows it's when it has to be a very complicated um, um, complicated payment term. You can take 1 term, CPO1, and split it up and make it 4. You know what I mean? Because you can have 2 within it, or you can have how many minutes? Because you can say day 5, day 6, day 7. You know what I mean? And you can have 1 for each of those day limits within that. All righty? Just so if you move on down here, you'll see this is applicable for both customer or vendor. It could be just one or the other. All righty? Now, when you set this baseline, you can add an amount of days as a buffer. All righty? So you can put 3 more days onto the 5 days. So for example, you can give them, let's say you give them 3 days, then the system will calculate and give the 5% if it's 17. If it's at 17. All righty? And you can put 3 days there. Or you can add a buffer for an additional month. So this is the system. So when the system call is the baseline date is the calculation date. So if you were in April 1st, right? The baseline date, if you had 5%, what would that date be that the system would calculate as the baseline date? April 15th, right? It's going to add the 14 days to it. And the baseline date will be April 14th. And if you add, and you put 2 more days, 3 more days, 3 more days in the fixed date, it's going to make it the 17th, April 17th. You follow me? And people would typically add a few more days just as a buffer. You'll see this on the customer side, like I'm going to still give them because of the amount of time that it typically takes for me to process the payment. Even though we received it on the 1st, I couldn't get to it and really process it in the system until the 3rd, because just it has to go through the normal change. And so you just add a little buffer. I'm going to give it to you 2% because I have internal processing time and internal time that takes time to get to the process. It'll take 2-3 days just to get through our company to get to my desk, kind of thing. You know what I mean? You know what I mean? Hello?
Yes, yes, I'm with you, Rod.
Okay. And then this just added buffer. Now, so that's adding buffer to it. So the baseline date, and then you're telling it what are you going to calculate the baseline date from, right? So this section, you're saying, well, this is how you calculate the baseline date. What, you know, or you're going to add any more days or month to the baseline date that you define down here. You remember, so you did this number of days. This will just add some buffer to it. This is saying, what is the date you're going to start from? So when you enter a transaction an invoice into the transaction, you enter an invoice into the system for a particular vendor that has this payment terms. The two things you have to, two things you have to enter on that invoice: a document date and a posting date. Okay, you've seen them. So when you enter the invoice, you put what is the document date? That was the document date is referring to what does the actual paper copy of the invoice say? And then here's your posting date, the date you're going to post it into the system, right? So those are two dates you enter. And you're saying, what is the baseline date starts from? And so if you put the document date and then you enter the document date and you put November 1st as a document date, and then you said the posting date is December 3rd, but the baseline date was November 30th, then, and you have this button ticked off, then the 14 days, according to this term, or the 20 days, is going to be starting from the date of the document date and not the date of the posting date or the date of the entry date. Because you could put the November 30th, the posting date is December 3rd, but you're entering it in on December 5th. You know what I mean? This one you don't have to pick because the system is going to do that automatically in the background, right? It's going to be the day you enter it. It's going to do a date and timestamp on everything that goes into the system. But if you pick this, then the system is going to calculate the 14 days, the 20 days, and the 30 days from that date. Okay? And so you're basically defining it from that. Okay? Now, and then you can actually define some defaults, like if you use this key, whether it's automatic blocking and what's the payment method specifically defined. If you want to further define, you can, if you want to create a payment term that's for installment payments, then you would click this guy to pick it, and then this payment will be a payment term that's going to be in installments. And of course, installments mean, and then when you do installments, you're going to have some percentages, like let's say installments of 25%. Then you can have 4 installment payments of 25, 25, 25, and then you can define how the frequency when you have to make the 25. You can see this is not an installment payment. It has to be paid in full with the discounts if it falls within this frame. And if it's an installment, then you pay a partial of equal amounts over 3-month period or something. You follow me?
Yes, I'm tracking you, right.
Okay. These are also used, so you can use this guy here as an overall buffer. But if you use the fixed date and additional months, and for each line, you can also add the buffer in here. So you can see 5%, 14 days. And if you want to give a buffer specifically to that particular one, you would give it here. but this is just overall. But if you do it here, then this specifically is to that role, okay, or that particular condition. And then this is just a definition going forward. This is just a definition right there, okay? Before I move on, so now you can see a little bit of what each of these fields represent within that uh, this configuration point. All right.
Yes, sir.
So now, um, I don't think we need to kind of go into the create, but this account payable program is kind of
See that one I'm sorry. I don't want to stop you. Go ahead.
no. Go ahead, please. Which one? Which one you want to tell us about?
I was just saying the automatic payment program. I have documentation on this one. This is the one that they put into the bank accounting.
Okay. Yes. 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 The one they put into the bank account.
Mm-hmm.
Oh, okay. So you're good with it?
No, please. Give me as much as you desire.
Oh, okay. Oh,
Everything
okay.
you add is
Okay.
a benefit.
Oh, okay. So now this is what. So in this automatic payment program, this payment program, if you put into the system these transactions, you go into this thing. There's one place you can go. It's gonna or you can put in F110. If you go into the actual payment program is F110. That's a transaction, right? And then if you go into F110, it's going to take you to the payment program that you got to enter all the pay. You enter the payment program and then you enter. But if you go to F110 and you go to the menu, it's going to take you to this screen right here. You go to the menu in F110 in the menu that says go and define customization, and it'll take you right here, right within the payment program screen. It'll take you to these things. Now, um, if you go through these six, you pretty much can define how the payment program kind of works. Now, the system is going to come with some standard ones, and you can leverage off of it. All righty. This tool will take you right there to this list. Now, what I'm just kind of overview of here, what you're saying is that every company has to be entered into this guy, right? And you go into this menu, every company. Now, every company doesn't have to pay for itself. Doesn't have to. So if you have a pay, doesn't have to be a paying company. So you give me an example. You can have company 1, 2, and 3, and you would enter all three of them here, right? But then company 1 could be the paying company for 1, 2, and 3. All right. We use the term called centralized payment when that kind of situation happens, where one company is paying on behalf of multiple companies. That is called centralized pay. If it's decentralized payments, then you would have three companies here, company 1, 2, and 3, and then each paying company would be represented here as well. Paying companies paying 1, paying company pay 2 for company 2, and paying company 3 pays for company code 3. All right, that's decentralized payment, right? Each company pays on its own behalf. So you have three separate setups, or you have a centralized payment. You only have to have the payment per paying company for one. Now, also in the system, you have to set the payment methods by country code, and you have to have the payment methods by country. So country and company code. Now, the payment methods is wire, ACH, checks, direct debits. Those are typical payment terms. Checks, ACH, wire, direct debits. Ready? So you would set up for the particular country and in a particular company. We're going to focus just US here. Every country do not have ACH, right? And a lot of other companies have other
SEPA.
form. Go ahead.
Europe has SEPA, right?
Huh?
Uh, SEPA in Europe.
Yes, 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 yes,
Mhm.
yes, yes, yes. And that is that is a formal, it's still electronic payments. Europe and a lot of other countries are more advanced in terms of electronic payments than the US. There has always been a tradition where US people always wanted their checks. And it's very recently that within the last 5, 10 years, that has been a big push to get people to do more electronic direct deposits and electronic payments. But in the past, it was just all checks, 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 checks. And that was just a US custom, that was just a US custom thing. But most of the other world, other than the US, had moved forward onto electronic payments. You take India, for example, they have, uh, they almost trying to take cash out of the system. It's all electronic payment. Or 90% of the payments are electronic payments, or 95, you know what I mean? Cash is out of it. You know, everybody got a phone and you have to pay electronically. All righty. In Europe, it's they pay people pay more electronically than US. But there's a big, we constantly pushing to do it, right? To do more ACH direct deposits and direct debits and things like that. More and more now than we ever had. So, but you have to set it up at the country level and you have to set it up at the company code level. And then when you go to the bank determination, you're down in here, you're just doing the details. What GLs you're going to pose. If you have a wire, if you have a ACH, all of those big determinations, right? Um, you're just defining the specific accounting rules to use for each and every one. Within these over here, you're going to be defining um, what kind of format the file is going to be. Is it going to be an ACH format? Is it going to be a check format? What's the form? How does the check print out? You know what I mean? Does it need dual signature? All of those things are going to be embedded into these guys in here. And then the house bank is each bank account is where a house bank. Did you get to what's a house bank?
Yeah, it's a bank key, but it's the bank that the that our company is going to use to actually make and receive payments.
Very good, Rich. Very good. Very good.
Yeah.
Yep. And then in the house bank, you got, so for example, a house bank is Chase. A house bank is Bank of America. A house bank is, the local bank, the bank, and then the bank account resides under the house bank. So what we would have is a bank account, for deposits, a bank account for disbursements, a bank account for payroll, a bank account for taxes. And then each one of them will represent a house bank. And then one house bank would be Chase. And then you can have 4 bank accounts under it. All righty. And then when you go and define these terms, you're going to point to different ledgers to point it out. Now, in bank accounting, we typically create ledgers, right? So that we can, and it'll explain when we were talking about when you create cash accounts and integrate with the bank, you usually set up about the GL accounts. For every bank account, you give the GL 10 accounts. Did that kind of, do you remember this conversation?
Yes,
10,
you taught me
10,
this
10
before I
GL.
knew anything about bank accounting.
You,
You gave me this information, but please,
oh, okay.
it'd be nice to hear it again.
Okay. And so what you will say is that you give it 10 accounts. The main account, which is the main account, like a disbursement account, is used for making payments. Depository accounts, moving for collecting cash for a lot. But let's say you have a a disbursement account. The the main account we always do it when we set up ends with 0. That's really the main account, right? That's really the main account. And all of the even numbers within that group. So let's give an example of an account. 100, 100. Let's say you have a number range for your cash group. You remember we had an account group, and we had a number range we assigned to the cash group, and the number range is 6 digits, and it must starts with a 0. I mean, it starts with a 1 and it's 6 digit, okay? And it's 0, 0, 0. And it's in the group, it'll be the range is from 1, 5 zeros to 1, 0, 9999. So you can have bank accounts within that same range. So the first bank account is going to be 100, 100, right? That's Chase depository account. The ledger number is 100, 100 for the 6 digits. The 0 really represents the main bank account. So it's 100, 100, right? It ends with the last number ends with a 0. The next, and then we typically organize is that every even number represents an outflow type, and every odd number represents an inflow type. Let me explain. 100, 102 is checks out. 100, 101 is checks in. 100, 103 is ACH in. 100, 104 is ACH outs. 100, 105 is wires in, and 106 is wires out. Direct debit. You follow me? You follow the pattern? Please confirm.
Yes, I'm tracking you.
Okay, so now, the reason we're doing that is that so that we can, when we send out a wire, so when we send out a wire, let's say we send a ACH out from the payment program, right? Right. The vendor is going to have a liability. We're going to pay the vendor. We owe a vendor $1,000, right? That vendor is going to have $1,000 credit on their account, right? So I'm just going to talk some debits and credits. Got a credit on this account for $1,000. So when we pay that vendor, we're going to debit that vendor account, and then we're going to credit the cash ACH account, right? I'll be crediting, 100, 103. Okay. So it says, okay, good. Now I know that was a ACH payment that cleared that vendor. It was an ACH payment because the vendor was debited and that's what you define in that bank determination. All right. And then you're going to say that the ACH account for the payment terms ACH is going to get credited, and the account number is going to be 100, 104. All right. For ACH out. All right. Now, ACH takes 3 days to clear. So it's going to sit in that account 100, 101 for 3 days, right? And then when we get an electronic bank statement come in, we can automatically post the ACH clearing. So the ACH will come in as on the bank statement. You got an electronic bank statement. I'm tying it together. The electronic bank statement will come in. It's going to clear it out of the ACH and put it into as a credit to the. So it's going to debit the ACH 104 account, 100, 104 account, and it's going to credit the main account. Now the main account has the record, right? It got into the main account, but we're using these accounts as sub accounts so that I can clear it when the electronic bank statement. If I bring an electronic bank statement in, I'm going to be posting them as well because they act just like GRIR kind of clearing account. That makes sense. Let me see. Can you? I want to make sure this point is clear.
You want me to say it back to you?
Yeah. You know what I'm saying, right?
Yes,
They
I
act
want to
like
study these.
GRIR. They act like
Uh,
GRIR
uh,
kind of thing.
yeah, what they, how did the GRIR, how they, oh geez, you got me reaching to
They're
debit
like
the
clearing.
expense. Yeah, you got the GRIR clearing, you got the acquisition clearing account for the fixed assets, kind of the same principle.
Mhm. Yeah.
And then
Yeah. Well, so those 10 accounts that we use under the zero, like the zero, it's like those are like sub accounts to the main account. And we're using them like clearing accounts. Like, okay, I told that when we pay a vendor for an ACH,
oh,
it's going
okay,
to hit the
okay,
ACH. It's going to hit the ACH out account, right? When the electronic bank statement comes in, it's going to clear it out of the ACH and put it to the main account, right? So it's acting as a wash, based,
yeah,
So it's really
I'm
two
tracking you
steps,
right.
huh?
I think I'm tracking you for those 10 accounts that you're saying that we assign to the true bank account,
Right.
that they're acting as clearing accounts like the GRIR.
Yes,
Right.
yes, 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 yes,
I
yes.
got you. And I'm gonna study this point. You gotta forgive me. That's the first time of me getting this information. I have to process things before I
Right, right, right,
retain it.
right, right.
Please
Understood,
forgive me.
understood,
Yeah.
understood. No, no,
Yeah.
no, no. That's why I wanted to just reiterate it back to,
Hmm.
so you see that, so you can see that we separate them so that, when the bank statement come in, when electronic bank statement come in, it's going to have
Mm-hmm.
a BII code that's going to be universal that
Mm-hmm.
says this is an ACH clearing, right?
Mm-hmm.
And when it's an ACH clearing, I know to go and credit the 100, 10. I know to go in and actually debit the 100, 104 account and and credit the 100, 100 account. It's going to automatically do that when we set up the bank configuration, right?
Mm-hmm.
So you pay it, you clear the vendor, you throw it to the ACH, you throw it to the ACH out account, the 104. And then when electronic bank statement comes in, you clear it out of the 104 and you put it to the main. It's like active. All those under the main access washing accounts. Okay. So let's continue. And then we'll see it better as we go. So every company is going to have, when you go into that company, you're going to have the company code, and you're going to have a sending company and a paying company. You see that?
Yes.
Each configuration is going to have. Now, if they're the same, what that implies?
That the
It's,
sending company is the paying company.
yeah, and it's a decentralized process, generally
Mm-hmm.
speaking, right? It's a
Mm-hmm.
decentralized process that, but then if you go into see a second company and you see that it has the
And
same
it's cent-
paying company,
and it's
then you're going to see
centralized.
it's centralized. Yeah.
Mm-hmm.
Uh, so when you come into this guy, you're going to have that. It's going to say, do you want payment supplemental information to be sent along with it? And then you can say tolerance, and you can give it all. Now here is uh, the here, the special geo indicators. Do you remember the special geo indicators?
Yeah, saying don't use that account, use this one instead.
That's right. So when you
Mm-hmm.
you process, if you want this payment program to consider the special geo indicators, you'll have an A, an F, a G. If you see all those special geo indicators for vendors, if you want them to consider those special geo indicators, you list them out right here.
Mm-hmm.
If you do not want the payment program to consider those special geo indicators, then it won't be listed. It would only pay uh, line items on a vendor record that's non-special geo indicators. And if you want the special geo indicators, you'll see they're usually a one letters payment special geo indicator, like an A, F, a G. You know what I'm saying,
Mm-hmm.
right?
Mm-hmm.
To consider them, you have to list them, and it'll be just a list without a comma. So you would just be A, G, H, and the system will will use at the list. And and do you know the payment program? You would also it can pay customers,
Mm-hmm.
right? And you would put those same special geo indicators if you want the payment programs to pay the customer and also consider the special geo indicators as well, right? Now, why would the payment program pay customers? What would be? Would we pay
Oh, it
vendors?
almost sounds like a refund
Yes,
or
yes.
a mm, okay.
Here's a situation where a customer owe a customer we owe a customer money. A customer overpaid or paid an invoice twice, right?
Mm-hmm.
So the customer came in and um, he paid 25,000 overpaid on the account for whatever odd reason, or this customer is he has some commissions or he has some discounts and some disputes. He had a dispute that we gave him a refund on something that he paid for it in advance, $10,000, but we gave him a warranty, and we would say if so the product failed, right? And then it failed only 10% of its use or something. So we said we will give him 10% of the value back or whatever, a refund. And so now the customer has a credit on their account. This payment program can actually pay customers that have credits. Now, if the customer is in an old position, it will never pay customers that have a debit position. A customer with a debit position means that they owe us, and it would pay customers that's in a credit position that we owe them. Also, if a vendor is in a debit position, it will never pay that vendor. And if the vendor is in a credit position, we will pay the vendor. But a vendor in a debit position, meaning that we got some credits from a vendor that we overpaid. You know what I mean? And we would have to get more invoices while that vendor is in a debit position. When we run the program, we won't pay until all invoices consume up the debit position. Follow me?
Yes.
Um, So this is just basically saying now this is saying we enter in a paying company. So these are the rules for the paying company now. So this button right up here, you can bounce back and forth when you're in the company view and you hit this button right here, it'll take you automatically to this second section right here. Right? You start here, it'll take you to this second section right there. Once you hit this button, and then it'll take you to this payment program section here. And this payment program section is saying, okay, you're defining some rules for the paying company. Uh, what is the maximum amount that you will pay? For example, you could say the minimum amount is $1 or 15 cents. You're not going to cut a check for 15 cents, or you're not going to cut a check for $3. You make it the minimum amount or the maximum, the minimum amount for incoming payments or outgoing payments. All right. And then these are just additional settings that you can make, if you want to separate the payment for each one. So if you had 3 invoices, right, you can say pay all 3 individually. And if you don't, it's going to consolidate all 3 invoices and club them, 5,000, 5,000, 4,000. It's going to pay a check for 14,000. And it'll club them if this is not checked. If this is checked, it will cut a check for 5,000, 5,000, 4,000. Follow me?
Yes.
Yeah. And so, uh, and then this is further defining. This. If you want to cut a check, you can tell the system that this is the sender details. You can put some details here so that it will get copied. In that form section here, that will be a form that you will start to you know, in the system, you can start defining forms, all right, which is just the output. A system with in SAP, the term form means output, like a invoice, a check. It's a form, right? And that's how they particularly call it. What we have two types of forms. The older version of forms is called SAP scripts. The newer version of forms is PDF files, PDFs, okay? But it used to be SAP scripts, and they moved away from the SAP scripts, but SAP scripts was still, it's a language that was creating that you would put the form. It's really like defining the boxes, you know, for the header. You know how you define a header? What's the body? What's the footer? Where the lines go? You know what I mean?
Yep.
It's defining a form in its in the very raw position, you know, in location, um, two spaces up from the left on row 25, column A, put the invoice number. You know what I mean? It's literally that detail. Okay. And
Mhm.
this is further definition of the same thing. I Bank of Exchanges, I don't typically use it, but I think it is more of a European thing, and so that's kind of a Bank of Exchange stuff. I don't use it. And then we're gonna stop here, Richard. Have
Okay.
to. And we so obviously we're gonna have. I hope this is helpful, man. I'm trying to I'll do my best.
Yes, it is. I appreciate you working with me with my limited internet here.
Okay. All right, sir. So we'll continue to define it further, and I'll talk to you later.
Very good. Thanks, Rod.
Goodbye.